Hello, I'm Alex McFarland, and I am a Consumer and Community Studies major, and that is within the College of Social and Behavioral Science. I want to dive in here. Dr. Kathleen Zick and I worked on this research for close to a year, and our work culminated in a comment that is forthcoming in the Journal of Consumer Affairs. And the premise of our research was is that the financial landscape has changed significantly in the last 50 years. And what does this mean for consumers? What does this mean for consumers who are trying to navigate through this market that is growing more and more complex? So you'll see on the screen, these are just a few of the areas in which the financial landscape has changed. So the retirement shift from defined benefit to defined contribution plans is significant. Defined contribution plans require active participation, and they also require calculating how much your needs will be in the future for or your retirement needs. Also, tax planning is a very complex area, and having a an accountant uh, who is competent is very, very helpful. They can save consumers lots of money. There are many tax sheltered mechanisms in the tax code, and so having a professional to guide you through is certainly helpful. Also, there are new market mechanisms now. There are exchange traded funds and commission free discount brokers. And there are applications on your smartphone that you can make instant stock trades. Um, and so, in some sense, the market is closer to consumers perhaps now than ever before, but there's still required a high level of financial literacy in order to navigate this market. Also, you'll see on the screen um, insurance purchases is a part of this, and also the rise of student debt is also an issue. So, in order to meet these challenges or this complexity, consumers will often look to a professional for help. Uh, and when they do, they will find this. And so this isn't even an exhaustive list of all the credentials. Dr. Zick and I found over 180 financial credentials on FINRA's database, online database. And you probably won't see them like this. They will probably look more like this. But still, we argue that this is not as still not as accessible to the consumer in terms of what these credentials are and what they do, and what their quality is. So, um, uh, when we dove into the literature review, we found that finance is often compared to other fields that are much more regulated with their credentials, such as law and medicine. So this graph illustrates that well. Um, Finance clearly paces these other fields, these other examples, in terms of the number of credentials that are available in the market. And in the literature, it was clear that consumers are confused. They're confused by the sheer volume of titles, but also the function, whether they're general or specific. And primarily, there is significant variation in the quality of these credentials. So one of the first things that Dr. Zick and I did was we took a sample of credentials and evaluated them based on a number of criteria, and you'll see that on the screen. And what we found was that some credentials required the completion of, say, 4 online courses, and that was enough for having the credential conferred. On the other end, there were credentials that required 8 to 10 classes, rigorous examination. There was an oversight board, code of ethics, continuing education requirements, and there was even a probation period, so that the professional had to log a certain amount of hours and shadow another professional before they had their credential conferred. So, with that consumer confusion, we then looked to see if there are any regulatory bodies that or if there's any regulation that help. And I will say there are many regulatory bodies involved in the financial market. And to summarize, it is often the action of the financial professional, not their title or credential, that triggers certain regulation. So, for example, if um, if a professional was working with a client of, say, $100 million in assets, and they were to offer specific securities advice, then they would trigger SEC regulation at the federal level. If they were doing the same thing but to with a client of lesser assets, then they would likely draw state level securities regulation. But if the professional was offering credence goods or general advice, then they probably wouldn't trigger any sort of regulation. And this is what we found to be interesting. These different spheres of regulation are often triggered by action. And you see that here, action and not necessarily title. We did, however, find two consumer protections that were that specifically targeted credentialing. Uh, they targeted the actual use of words within a financial title. And these were model regulations that were drafted by the National Association of Insurance Commissioners and the North American Securities Administrators Association. And after they were drafted, they were sent out to states, and some passed these regulations and others did not. Both of these regulations are almost identical in their language. Just one deals with insurance and the other deals with securities. And both of them prohibit the use of specific words like retirement or senior or elderly, any words that are meant to market specifically to senior consumers. Now, the exception is if the credential is certified by a third-party independent agency like the American National Standards Institute or the National Commission for Certifying Agencies, then that credential is qualified. But without those, then the credentials could not use those specific words. So then we wanted to know which states had passed these, and then more importantly, why. And what we found was that 23 states had passed one regulation at the exclusion of the other. 20 states had passed both, and 7 had passed neither. So then we decided to conduct interviews with a small sample of state-level securities and insurance administrators. And the purpose of these interviews was to see if these regulations were effective. And it was also to gain insight into how these policies went through the adoption process. Was it partisan in nature? Was it controversial? Were there any problematic conditions that gave rise to these? Then we looked at quantitative. Then we had a quantitative approach, and so we looked at the state's population, the proportion of 65 plus age group, and the governor's party affiliation. We also looked at the presence of a consumer support unit, and I'd like to note many states have their consumer support unit located within their attorney general's office, and some states have an independent agency or their own consumer department. And we wanted to know if that affected these policies passing in those states. The interviews provided great illustrations. You'll see at the top of the screen CHSG, and that stands for Certified High School Graduate. This was a credential that was used in violation of one of the state codes. And so this just demonstrates how some financial professionals know what the signaling mechanism of a credential is. So that was a great example. And then we learned about scare lunches, which this was happening in many states, but financial professionals would invite to lunch elderly investors, and they would proceed to scare them out of the market. They would describe to them periods of recession and market volatility generally, And the purpose was to get them to purchase insurance and annuities products. And so this was a problem. Also, some states uh, conveyed that they already had existing codes which address this issue, laws against false advertising or fraudulent marketing, and they believed that they didn't need to pass these regulations because they already had laws on their books which dealt with it. And here, I would like to add that from our research, uh, we don't think that if a professional had a credential, um, and say it was of low quality, we don't think that that would violate any false advertising or fraudulent marketing. Um, and but we still think that it does pose a problem for consumers of having many credentials that are low quality um, out there in the market. So that was was a discrepancy, and I wanted to make sure that that was noted. Also, in the interviews, it was conveyed that this was a nonpartisan issue. And then lastly, states did not track the effectiveness of these policies, and that was a bit of a disappointment. We wanted to see if they were very helpful. We were hoping to see if there were, if they kept track of violations and to see if the violations had tiered off, but there was no data available. In the quantitative analysis, a few things are notable. First, that states that had an independent or Democratic governor were 2.5 times more likely to pass the NASA policy and 3 times more likely to pass the NAIC policy than a Republican-led state administration. And also, we found a negative correlation between the population of 65 plus and the passing of the NAIC policy. So as that 65 plus group grew, passing the NAIC, it was less likely that that policy would be on the books. And we have some ideas for why that may be, but we would need more research. We would need more research to verify. So a few conclusions. One, it seems that adopting one policy at the exclusion of the other suggests a lack of inter-administrative communication. They're both nearly identical in their language, so it seems odd that one would be passed without the other. And then secondly, this may very well be a partisan issue, though that didn't come through in the interviews. That was just a small sample of states, whereas the quantitative was the full 50 spectrum. Also, the full 50 range. Also, little if any statistics on these policies' effectiveness is out there. When Dr. Zick and I went back to FINRA's database, we noticed that many credentials that have words like retirement or elderly, a lot of those credentials are no longer being conferred, or they are no longer active. And so we want to know, of course, do these policies have anything to do with that? And so we would need more research to get into that. Also, my favorite part of this research was finding that one state in particular had modified the language to not only prohibit retirement type words or senior words, but actually any words that market something that the credential is not certified in doing. And this was significant because this was really the thing that we hoped to find in the market, was a code that could protect all consumers from low quality or self-conferred designations. And so we did find this on the state level in one state. Also, this is an area that is ripe for continued research. The financial services market is growing in its complexity, and as the age distribution continues to change, this continues to be an area ripe for research. Thank you for watching this, and I want to say a big thank you to Dr. Kathleen Zick for being a great mentor in this process. Thank you so much for watching this.